Hello traders, welcome to Trade the Bear. This is the next part in our free trading course that's being offered by me, Stacy, and just want to say that I have over 20 years experience trading the market. I have traded everything from options to binaries, which not a lot of folks are aware of, to futures, and of course stocks. We trade that as well. But I would love to take this time and help you become a more confident and successful trader. And so we're going to be talking about one of the most important parts in trading, which is money management. I had a mentor of mine tell me one time that with good money management, you'll never go broke. You may not make a lot of money, but you never go broke. But I'm going to tell you that with the systems that we have here at Trade the Bear, we will make money, and we will not put too much risk on at any given time or any given trade. And this particular trading course will help you understand that. So how much are you willing to invest in a trade or a trading system? So money management, it's not how much you make, but how much you keep. How hard it works for you and how many generations you keep it for. Robert Kiyosaki has written the books Rich Dad, Poor Dad. I highly recommend, especially I believe it's his first book, which is just titled Rich Dad, Poor Dad. And he explains very clearly the differences between people who work for a living and people who have their money working for them to help them make a living. And I think you'll find that book very, very good if you haven't read it already. So the main reason portfolios blow up is because of poor money management. You'll make a trade, and I think one of the first trades I ever made, it was super. I mean, it turned me into a bull right out of the chute. I mean, it was basically put a little money in the market, and the market went in the direction that I thought it was going to go, and I did very well. Well, that's great for your first trade, which caused me to feel really good about myself, and learned later that when I took a couple of losses that I didn't feel so good about myself. So money management is going to keep the craziness going on. So there's a thing called seesaw money management where you'll make one trade, you're a win. You make another trade, you win. You make another trade, you win, and you say, hey, I've got it figured out. Let's go all in on the market. So, well, you were only putting maybe $200, $300, $400, maybe $1,000 in the market at that time. And let's say you boosted it up to $2,000 because you were doing so well. And then your next three trades are a loss. Well, that's not very good money management. And this is going to keep you from being a gambler. This is going to have you become a trader. There's a big difference between gambling and trading. The good thing about trading is we get to manage the probabilities, where in gambling, the casino or basic luck is what you're looking for. This is not about luck. This is about managing probabilities. And we'll talk more about that as we go along. So there's 3 rules that we have to follow to have good money management. Rule number 1, don't put all your eggs in one basket. Rule number 2, decide beforehand how much you are willing to risk in a single trade. And then rule number 3, plan your trade and trade your plan. So let's talk about these rules. All right, rule number 1, don't put all your eggs in one basket. Diversify, diversify, diversify. Never more than 10% of your portfolio at risk at any given point in time. Now I'm talking about your trading portfolio. When it comes to 401ks and stuff like that, I'll talk about that in a minute. But on any given trade, I prefer in my larger trading accounts to never risk more than 2% on a given trade. And you'll see that pretty much throughout the Trade the Bear system that we follow this rule. The only exception is when we trade small accounts. When we're trading a small account, we're going to trade 5%. Now, the difference is we're not going to risk 10% at any given time because we're only going to manage one trade. And that's where we're able to do 5%, and we're only going to have one trade on. So how much risk do we have to the portfolio? 5%. But we're managing a smaller account. And that's how you can take a small account to a large account in a relatively short period of time. If you tried to do 2% and 10 trades, the problem is With a smaller account, you're not able to get enough position size to really have an impact and grow the portfolio in a quick period of time. So that's what I'm doing right now with the small account until it gets up to a little bit larger amount of money. We'll pretty much be trading the XLF, which is a pretty inexpensive ETF to trade. Now, many trades in a portfolio may have no risk. So what do I mean by that? Well, let's say I put a trade on, say the XLF. I put a trade on. No, let's talk about the XLE. I put an XLE trade on, and maybe I've scaled half of the trade. Now I have no risk on that particular trade, so I have no risk to my portfolio. The maximum I could lose at that point would bring me to break even, so there's no risk on the trade, so I can use that risk for the next trade. Hopefully that makes sense. Many trades, position trading is different. 401ks, Roths, and IRAs. So a 401k, I have a managed 401k account where I manage the account myself. Basically, I'm just buying the S&P 500. I'm dollar cost averaging in, and just buying as much of it as I can. But what I do is I have another account that I hedge with. So my trading account is hedging my 401k. So in this last big move down, we were short over in the smaller account. The larger account, I really didn't have enough time to pull the money out of that account before it already made its move. So what we were able to do is we actually made money in the market when that downtrend happened, because we used our smaller account, our trading account, to hedge our larger account. And we'll be teaching more about that as time goes on. So did I say diversify, diversify, diversify? Very, very important. Okay. Rule number 2, decide beforehand how much you are willing to risk in a single trade. Technical traders define risk different than maybe a position trader will. A position trader will look often at his account and say, I have this much at risk, because he's thinking in terms of how much the trade cost him, well, or her. And I prefer to look at it a little differently. So I look at, where's my stop? I always have a stop in the trade. And even if I don't have a physical stop, which I recommend highly you have, I'll have a mental stop. And so what I'm going to do is I'm going to take the difference between the entry and the stop, and that's my true risk. And so let's go into an example of what that would look like. So let's say we have a portfolio of $10,000, and we're willing to risk 2% on a given trade. So $200 will be our risk. So if we're going to buy a stock of a $50 stock, okay, if we were to buy 40 contracts on a $50 stock, we'd be looking at a $2,000 cost of the trade. Well, we don't have that much at risk because we have a stop at $45. So the 50 minus the 4, 45 is 5. So you do the 200 divided by the 5, and that gives you 40, which will give you the amount of contracts that you're going to buy. So my risk is $200, but my cost of trade is $2,000. So you see how that works with a stock. Now, on an option, it's a little different, because remember, an option is renting the given ETF or the stock. So when you rent the stock, you're paying a premium, okay? And that premium runs out at a certain point in time, which we'll talk about when we get into the basic options part of this free trading. So let's say the cost of the option is $5, and our tolerable loss is 3, so we really only have $2 at risk. So you're going to have $200 divided by 2, which is what, 100. Well, every option, when you buy one contract, you're buying 100, you're controlling 100 shares of the stock. So we would be able to buy one contract. So what would that be? The cost of the trade would be what, $2,500? Is that right? 200 times 5. No, $1,000. It's $1,000. I didn't think that sounded right. So so that's how we manage risk, and I'm going to be doing a webinar real soon, and we'll be talking more about this. Rewind this, watch it over and over again until you understand this concept and you really drill this down. All right, so the next rule is rule number 3 is plan your trade and trade your plan. So what do I mean by plan your trade? A lot of traders do not want to do the homework that it takes to do that. You know how we were talking earlier about overcoming fear and greed? You know, when you're losing in a trade, you're experiencing fear. You feel like the world's picking on you. You know, why is the universe doing this to me? Why is God doing this to me? I mean, you have all these different things that go through your head. And sometimes the longest journey in trading is from the brain to the mouse, because you have all this feeling and emotion and greed and fear and everything going on, and you're just afraid to hit the mouse. Well, this is how you overcome the fear and the greed. And you know, the greed, when it comes in, and it can be really bad as well, because you get this feeling like you're Superman and nothing can touch you because you've just had 9 trades in a row. Every one of them was a winner. Nothing can touch you, and you have to be careful because it will come up and it will bite you. So how do we overcome this? Well, we do manual backtesting. What do I mean by manual backtesting? That's where you sit down with the charts. You have an idea in your mind about how you can trade a particular strategy. So write out that strategy and follow science. I mean, follow scientific rules where you don't change the rules as you go along as you're doing this. So, I mean, it's simple as look at the chart, write down win, 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 loss, 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 win, 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 loss, win, loss, win, loss, and do this until you have developed the rules. And if you get to a point where you say, wow, wait a minute, I need to change this or I need to change this, you need to erase every one of those W's and those L's, and you have to start completely over. But the manual backtesting is very important. Now, a new tool that we have just in the last few years is from Thinkorswim. It's called On Demand. So with On Demand, we can go back in time and we can test that theory and we can test that trade. We can actually put the trade on and we can fast forward and see how we did. So then go in and do your back testing in On Demand. I've spent many hours in On Demand using that tool to help me develop a trading plan. And then once you have the trading plan developed, then you paper trade it. What do I mean by paper trade? Well, just like Monopoly money, you know, you're going to use a fake account. You're going to trade it just like it's a real account, and you're going to get into the bugs and what happens in real life part of it. And then once maybe you've done 50 trades in paper, then you have yourself a live trading plan. So that's very important. So plan your trade your plan. Here's the steps: manual backtesting, and then paper trade, and then live trade. Now, when you get to the live trade step, maybe you back off of the 2% risk and you only risk 1% until you've tested until you've tested that strategy in real time and real money. And then once you have, then you can turn it on and let her rip. Okay, so this has been about money management. Hopefully you've enjoyed this, and hopefully you've taken this to heart, because this is one of the most important parts of a trading game plan, and how you manage your portfolio and how you manage each of the trades. So thank you for spending time with me and taking the time to get through this video. If you are not already a Trade the Bear subscriber, please subscribe below and go to our website and join the Trade the Bear team. Thank you.